Looking at the stock market from a historical sense, we can try to have an idea as to when a particular market has become overvalued so that we can realign our portfolios. Instead, what has happened is that people simply double down. They are worried about missing out on the spectacular gains that just keep coming. This is getting very interesting. You came here for the truth, so let me unveil that for you. Today, we're going to look at some technical analysis that will show us what has happened and what will be coming in the next weeks and months. Let's begin. The chart below is important because it shows that over the past 20 years, the S&P 500 has, quote, never traded above its 50-month upper Bollinger Band, except for the 7 months preceding this one. Simply put, the market has not been more overvalued in at least the past 20 years as it was last month. That's how overvalued the market had become. Looking at this, March 2009, the S&P was at 666, and ever since then we have seen it rise dramatically. There have been some small setbacks along the way, no doubt, but it always retraces its steps. And of course, if we look at the G3 central bank balance sheet or the G4 or 5, we will see that they are completely correlated with the stock market, particularly in the US. That's a fact. I've covered that many times before. You know that. Here we have a little problem, however, and that is there is this sense of turbulence that has occurred, and in this case, it happened to be volatility. The name of the game was short volatility. As long as this can continue, there's nothing to worry about. But of course, when it doesn't continue, then that becomes the worst thing to be holding. Well, when you have a market that's been going in one direction for such a long period of time, it seems like only a fool would take the opposite side of that bet. Many people were looking at the market, 2010, 11, 12, and so on, thinking that it should be going downward. Why? Because everybody was looking at the fundamentals. Too much debt, problems haven't been solved, banks keep getting bigger, too big to fail just kept getting worse. You're seeing the derivatives expand. We are looking around the world, seeing the geopolitical issues. We can see that the phony jobs numbers keep coming out. Nothing's changed there. Unemployment's worse than ever before. We're looking at the people on the streets just continue to increase. I mean, you just add it all up and it shows us what has happened. But it doesn't matter. The only thing that ever matters is the central bank balance sheets. Let me reiterate. I've done entire videos about this. If the central bank is willing to print enough currency to completely destroy it, the stock market can continue to go higher. They have to be willing to go all the way. They have to put the pedal to the metal. They have to run the printing presses 24/7. There have been some currencies in the past, just for your information for those who don't know, who were only getting printed on one side. That's how fast this money was being devalued. It wasn't even worth printing on both sides. That's what's going to happen, but on a global scale. And just before it gets to that critical moment, the central bankers will come together and they will have a resolution. Of course, it had already been prepared. All right, now what you're seeing here, path of the S&P 500 during 11 non-recession corrections since 1976, as of February 8th. All right, showing us here the current situation. Basically, for all of the previous instances, there have been 11 times that the market came down as it did, but didn't result in a recession, all right? And it basically says that when you read the article that goes along with this is Goldman Sachs, that in this instance, you would actually have to see the market come down another 6%, I believe was the statistic. It didn't go low enough, and it would need to come down another 6% for it to get back to just a historical sense of how these corrections, let's call it, for just to make everybody happy, got to be politically correct even in this environment. It's anyway, won't go there. So these corrections need to occur, and it happens every so often, but it would need to come down another 6%. Okay, that's just the way it is. Now, people need to sweat every so often. It's good for you. It's good for you to sweat. And so that's really what needs to happen. Whether or not they'll allow it to happen, I don't know. But you can see basically the band in which it will potentially go. Most people are, of course, hoping it's this one up at the top. We'll see. Definitely. I'm not really sure where it will go. I'm surprised that the central banks haven't come out and reassured everybody at this point. Because I've noted something, and I'll bring it up in a moment. Now, the volatility of volatility, I showed you this before. I don't know if it was this current number, but it doesn't matter. When we look at the VVIX, you can see what has happened. I mean, absolutely skyrocketing. Nobody ever predicted that this would happen, even though I kept telling everybody, look at the volatility, look how far it is down. I mean, at a level of 8, it's basically non-existent. So anybody taking the opposite side of that bet might have really profited from this. CFTC VIX futures net speculative positioning. Okay, this is just, you can see the sea of red basically in this trend line here, but look at what happened in such a short period of time. Out of nowhere. I mean, no algorithm would have ever predicted that. With all of this in this region here, no algorithm would have ever predicted that. And that's what happened. A lot of people really lost a lot of money. Short volatility crisis, basically showing you here the implied equity correlation. You can see what is going on. I mean, all of these different actions that have taken place along these years, nothing in comparison to what just happened. It shocked everybody, really shocked the markets. Now, Fed's Harker says that equity volatility makes sense based on the yields. And Zero Hedge said, and there is the green light for the next crash. I don't know if that's necessarily going to be, a fact that this is the crash and they're going to allow it to happen at this point. But I'll just say it's an interesting statement. Okay, I'll leave it at that. This is interesting here because you're looking at the critical stress. Let me show you this here maybe. Critical stress signal CSS risk off trigger. What I wanted to show you here was that there are 8 of the top 10, I believe this is. But anyway, 8 here in the top 13. Anyway, it doesn't matter. You're seeing here that they are all equities, all of these. They're all risky. Now, when you look at the market as a whole, a lot of people have been talking about bonds. Nobody was really thinking about what was happening with equities because they assumed volatility is going to remain low. Central banks are still going to be printing. They're going to be buying up the shares. That's fine. But look at what happened. Really, look at what happened in such a short period of time. Nobody was thinking about that. Meanwhile, bonds, obviously, completely out of whack. I mean, that's just a fiasco waiting to happen. But hey, look at what happened here. Equities have led the recent rise in cross-asset stress from 26 January lows, while rates, widely thought to be the trigger of the recent sell-off, had shown little signs of stress thus far. And that's one of the things, the central bank controls rates. They decide what rates will be. They can ultimately push them down. There are something called open market operations. Okay, open market operations are something that are, it's quite simple. Print money, manipulate the interest rates. And they do so obviously to have their own advantage. They can control the rates. All they got to do is print money. That's the very, very simple tactic. People don't realize, they think that, the interest rates, if you talk to people, I mean, this is silly, but if you talk to people in the financial industry, they believe that the rate is just set, like they just program it into a computer. They have to engage in open market operations. They have to print money for that to happen. So if natural forces are pushing interest rates higher, the only resolution is for a central bank to print more money to put them down. There's a finite amount that they can do this without destroying the currency, without causing massive inflation. Anyway, look at what's happened with equities. You can see, obviously, they've been stressed to the max. That's all for this video. If you found it informative, please give me a thumbs up. When you give me a thumbs up, it supports the channel. I appreciate that very much. Last but not least, if you found this video informative, I know that you will find my books, The Money GPS and my newer release, Global Economic Collapse, even more informative. You can actually flip through these books. If you go over to Amazon, they have a look inside feature. It's going to allow you to flip through the pages of these books to see if you like them. Take care.